Have you been trying to buy a house and you're just seeing the prices going up, and you're like, you know what? And then interest rates are going up and you're just ready to give up? Well, this video is for you because we're going to be talking about a strategy called the 2-1 buy down. And we've got Chad Bergman here with Movement Mortgage that is going to explain how this thing works and how it is a tool for affordability. So don't think that you've been priced out until you explore this option. So thank you very much, Chad, for joining us.
Thanks, Joan. Again, it's always great to be talking to you and working with you. We have a lot to get through today, so let's jump into the 2-1 buy down and some opportunity we have today.
That sounds great. So yeah, we want to go ahead and just start. I think that you're going to kind of start with some of the big picture of interest rates and how, what some of the fears are that people have around it. And then we're going to go into more details of the 2-1 buy down, including an example.
Correct. So, again, everyone, our market is shifting right now. And it's shifting primarily due to higher interest rates, harder affordability due to that, and given our prices and our appreciation. And with a possible recession, being stimulated by the Fed right now because of higher interest rates. But what I want to show you is a historical graph that shows what mortgage rates do during a recession. So going into a recession, the Fed is typically hiking rates. But when we come out of a recession, it is a prosperous time. It is a time for the Fed to bring back interest rates, to reset them. So historically, we are usually looking at lower interest rates, after a recession. And the recession that is predicted, that's being talked about, is going to be a mild recession. So it is very important to keep that in mind because when rates do come back down, I do expect, and other people expect, that our housing market is going to go back to very competitive nature that we had earlier this spring. So we actually have a great opportunity for buyers specifically to get in the properties, without bidding wars, without crazy escalation clauses, and with the opportunity for sellers to even pay for what's called the 2-1 buy down.
Yeah. So what we're talking about here is that, the mortgage rates and that are higher now, they're still near the historic low.
Historically, yeah.
Yeah, but later, if they go down again, then those bidding wars are probably going to come back because we still have the supply and demand issue. So, so that's what we're talking about today is how you can take advantage of this time where I'm hearing some of my fellow realtors saying, I have a house that's been on the market for 14 days and no offers. And that's like insane compared to what it's been just in the previous few months. So
That's right.
to kind of see this time as potentially an opportunity for buyers and sellers. So
Absolutely.
what about this graph then? What are we
Well, this
looking at?
graph, again, kind of shows historically since the 60s what home values do through a recession. And again, we see, just a constant increase in appreciation, with the exception of 2008, in that we had a much different landscape as far as the problems of 2008 and the financial crisis and a lot of foreclosures and bad loans that were made. We don't have those same things in place today. But historically, again, housing stays strong during recessions.
And so I can't quite see all of that. I don't know if you can enlarge that part of but what is the time frame that this graph is along the lower, the x-axis?
Yeah, so it's 1960 to all the way to 2021.
Okay. And I think the other thing about this is even if you bought at the top before it took that crash, you
Yep.
can see that, yes, people that bought then did lose value, but then it started climbing up again. So kind of depending how that went, you probably still were able to make a return on your investment. So to kind of think about, even if you're concerned that the prices might drop, you
Hmm.
still might be in better shape to be a buyer than a renter or a waiter. Wait or yeah,
Yeah,
cool.
yeah. So yeah, definitely. Again, just long term, historically, real estate has always been a safe bet. And again, whatever bump we're seeing now is just an opportunity for buyers and honestly sellers too. What I also see is a lot of sellers who are now able to list their home, still get a great value for their home because of the appreciation that they've seen over the years. But more importantly, they're able to buy another property contingent. So it's
Right.
what a normal market should be, and we're in an opportunity for people to move up in property right now.
That's a very good point, that a lot of people were kind of freaked out, rightly so. Yeah, I can buy, but then where do I go? Do I really want to be in a bidding war with everybody else,
Yep.
and figuring that all out? So having a little bit calmer. I mean, it's still a seller's market just because of the supply and demand, but it's a little calmer. We don't have 4 months of inventory. We have maybe 4 to 6 weeks,
Hmm.
which is better than what it
Hmm.
was. But anyhow, so yeah, so let's go ahead and look at this idea of the 2-1 buy down. I don't know if you can even increase that a little bit more. If not, I think we can see it. Yeah, there you go. I
All
think that
right.
would be great. Yeah.
Yep.
Thank you.
Okay. So the 2-1 buy down isn't anything new. It's been around forever, but it really hasn't been part of our marketplace with historic low interest rates, over the past years. The idea behind the 2-1 buy down is that you are front loading your interest. You are basically buying down that interest rate, specifically 2 points lower than the note rate the first year, and then the second year it will be 1% lower for the second year, and then it will revert back to the full note rate for the remaining period of the time. This is a great opportunity, again, to take advantage of just the seller, again, maybe being more flexible and willing to pay for this. So again, that is really the design, is you get the seller to pay for this. It's going to help you out on that monthly payment, and we're really setting you up for a refinance. So a refinance in 2 to 3 years is kind of what is being talked about, given our current cycle in interest rates in the Fed, and again, the possible recession that's coming. So again, we are setting you up for a lower payment now with the expectation of a refinance down the road.
And so just an example, so if the rates are, maybe you're looking at 6% or
Mhm.
something now, and if you did this 2-1 buy down, if the seller was interested in paying for this 2-1 buy down, then you as the buyer would be at 4% the first year, 5% the next year, and then it would go back to 6%.
The 6%, yeah. And again, no one wants to be at 6%. And worst case, we need to be prepared for that 6% interest rate in case rates don't come down as quickly as we think they will. But it is honestly probably a more conservative option than say an ARM. So typically like a 3, 5, or 7 year ARM, those are locked in for a period of time. But when you come up for an adjustment with an ARM, if you're not able to refinance, you will go through an adjustment. And let's say that the margin and then the index, which is tied to typically the, um, the Fed funds rate, if that index is higher because of inflation, you could see adjustments every 6 months or every 12 months with an R when you go through it. So at least with the buy down, you know what it would cap out at. With an ARM, there's a lot of unknowns if you go through adjustment.
Okay. And so ARM, adjustable rate mortgage. Yeah, that's something that those of us who are a little bit older,
Yeah,
that when their inflation was off the charts and interest rates were higher
that's right.
decades ago, that was pretty common, one of the few ways that people could get in, that first-time home buyers. So you're saying that, so if somebody mentions an ARM, then you can go back and say, well, wait, I think maybe let's look at this 2-1 temporary buy down as an option.
As an option, yeah. And it's honestly, we're going to get a much better interest rate than an ARM right now too, because ARMs are just not being priced very well in the market, just given kind of the secondary market and what Fannie and Freddie has an appetite for. So the 2-1 buy down is really going to give you the best monthly savings, and again get you kind of that relief to get into that home now. What's nice about the 2-1 buy down too is it can be tied to your conventional financing, your FHA financing, and your VA. This does not, we don't, the buy downs aren't allowed for jumbo. So typically 684 and above loan amounts, that's considered jumbo. We also can do this with, again, a low down payment option, such as FHA, 3.5%. Or with conventional, with Fannie Mae Home Ready or Freddie Mac's Home Possible program, we can do this with as little as 3% down with the buy down. So a lot of flexibility.
So you're saying those programs are down payment assistance, or what are those programs, like kind of first-time home buyer?
Yeah. So the Fannie Mae Home Ready program is it's basically reduced mortgage insurance, a little bit reduced interest rate if you meet the criteria. The criteria typically is being a first-time home buyer, not always. I think the Freddie Mac doesn't require being a first-time home buyer, but the programs that I'm referring to, those are income AMI. So you have to fall under the average median income for the property you're buying, and I think that's right around 90,000. Those limits just got revised
in Denver.
Yep.
Okay. Okay, cool. So the takeaway here is this is not in lieu of like getting a VA loan or something else. It's something that could be in addition to a really good program that you're already in. And one of the things I was going to ask, and maybe you're going to get in this, but why would a seller? So I understand for a buyer,
yep,
great. You've reduced your first year interest rate, your second year interest rate. That's all good.
Yeah.
But why would a seller even be interested in this compared to just doing a price reduction?
Absolutely. Great question, Joan. So, again, when a seller's now longer days on market, properties aren't selling as easily. And so a seller is looking for, again, how can I compete and get my house sold? Still at the top dollar, how can I get the most money? That's what a seller wants, without coming off of my price. So from a seller standpoint, if you reduce your home price, say $10,000 for a buyer, it's only going to change the buyer's monthly payment by about $55, $57 a month.
That is a wild number.
It
so
is.
A $10,000 change in price translates to maybe, what did you say, like $57 a month?
$57 at today's interest rates.
And your payment.
Yeah.
So,
but as an alternative, a seller could maybe give $6,000 towards the buyer to do the 2-1 buy down. That is less money out of pocket the seller has to come up with, less proceeds. So the seller is going to get more money, but it's going to be a better value for the buyer because it's going to reduce, again, with that buy down, that interest rate for the buyer, 2% the first year, 1% the second year.
What does that translate to then? Like I know, so I see you've got an example here. So like for a $300,000 house,
yep,
changing the interest rate by 1% or 2%.
Yeah. So this, is just kind of a more of a detailed analysis of, do I do a price break from a seller standpoint, or from a buyer standpoint, or do I do the 2-1 buy down? And again, depending on your timeline, it's going to, it's going to be a little different. But for the most part, it's going to be a better value to do the buy down short term, because you are really getting that reduced mortgage payment for basically 24 months. And then again, because a price break really just doesn't do much to your monthly payment.
So I'm not sure what we're looking at exactly. So I was just trying to figure
Sure.
out. So for a buyer,
Yeah.
if you are able to have your payments at 4% compared to 6%,
Mm-hmm.
what does that kind of translate to?
So again, it's going to vary based on everyone's loan amount.
Oh, okay.
Yeah, because the loan amount's going to really be different. Whether it's a $300,000 loan amount or $500,000 loan amount. So that's where we just really need to dive into specifics for each buyer. But in this situation, I think it was about a $300,000 sales price, and I think we were talking about. So I think here it shows about a $11,000 savings, for a temporary buy
Gotcha.
down versus a price break.
Okay. And in this case, okay, I'm seeing that now. So regular financing, so the temporary buy down column, that second column there.
Mm-hmm.
So the buyer benefit is 58.65. And so are you saying that the seller might also throw in closing cost along with the 2-1 buy down?
So I think it's, as you know, Joan, real estate is a negotiable term. So,
Right.
different loan programs allow for different concessions. FHA, I believe, is up to 6%. So we can easily, get closing costs and buy down paid with 6%. With conventional, depending on the down payment, those concessions vary. I believe it's 3% if you're putting down up to 10% down for conventional. So the buy down, to give you an example, the cost of the buy down is going to vary based on the loan amount, but as a rule of thumb, it's about 2.3% of the loan amount is the cost of the buy down. So that's what you're, again, working with a good agent like yourself. We know the numbers ahead of time when we go in to make an offer. We know how much we need for the buy down, and why not ask for closing costs as well?
Okay, this is great. And also, what I love about this too is that we knew we would reach this point in our discussion where your head might have just exploded, where you're just like, wait, what did he just say?
Yeah.
And this is why we just kind of wanted to make sure that to ask about a 2-1 buy down. And then if you work with Chad or whoever, then they're going to be able to walk through the details for your situation.
Mm-hmm.
And just to kind of back up a little, the process when you're making an offer, that you're getting pre-approved first with your lender and going through these numbers and coming up with a plan before you make your offer.
Absolutely.
So you're not just like throwing things out there, but you really know what the impact is, how this affects you, if you're going to be pre-approved for it, if it's a reasonable thing to do. So you're not on your own when you're doing this, but we just wanted you to know that if you're concerned about not being able to afford, then this might be a way to get into something at this specific time when sellers are, yeah, they were expecting to sell, like have 10 offers in the first 2 days. And now things are sitting there for 14 days without an offer. So this is a good time to come in with something more creative and see how that goes.
Absolutely. Yep. So, yeah, I think again, the way I treat my business, Joan, as you know, I dig deeper, especially with first time home buyers, we get more specific to the numbers, examples. A lot of times before making an offer, I actually run numbers specific to the property. So we're pretty dialed in, at least the way I treat my business. So you have a lot of information to make informed decisions.
Yeah, and I think that's something that a lot of people don't realize. They think that, oh, well, let me not talk to a lender yet
Yeah,
until I know, more specifically what exact house I'm looking for, or maybe our jobs might change. But the message really is, no, talk to someone now, so
right.
that if there are any red flags, any little kind of weak areas, that you'll know and you can be working on those, so that when you are ready,
Mhm.
there's or you think you're ready, there's not something that's going to trip you up.
Exactly. Yeah. So financing, in my opinion, is a lot of it's done on the front end because there's a lot of stuff you have to do anyway when you're under contract, from inspections to, all the details of getting through the home purchase. My goal is to, work the financing on the front end. So once we're under contract, we update a few things, we sign disclosures, and we're off to the races. So,
Right. And
yeah.
for sellers also, to if you're thinking, wow, these people want a price reduction, what is that 2-1 buy down thing? Um,
Yep.
that you can contact Chad or the lender, and run through those numbers and see what kind of, how you could create a benefit for the buyer, but not just take a off the top
Yep.
reduction.
Yeah. Yeah. I mean, great example. I mean, again, no one wants to slash their price when they list their house initially. So again, maybe by offering the 2-1 buy down in broker remarks or, public comments, it's you're open to the idea, but you're still holding your price. I guess from a
Mm,
from a poker standpoint, you don't want to show all your cards, but you want to maybe let them know that you're open to a conversation about, um, you know, offering the 2-1 buy down, and things are still negotiable. So
right. Right. Yeah. Perfect. All right. So thank you so much for joining me again, Chad.
you're welcome.
And just a reminder that Chad is with Movement Mortgage. And if you want to reach him, the contact info is there in the description, but it's mydenvermortgage.com that has his email and phone number and all that good stuff. All right. Well, thank you very much, Chad, for hanging out with us.
Thank you, Joe. Yeah.
And I was really happy to do this because, the affordability in Denver and some other areas is at record lows, and
Mhm.
I just don't want you to give up. I don't want you to just think, well, maybe I'll wait 5 or 10 years, because I don't know that it's going to get any better or easier. So if you've got an inkling of an idea, then reach out to me, reach out to Chad, and let's see what things we can get going for you.
Perfectly said. Thanks again for the opportunity, John.
You bet. All right. Hope to see you all in the Mile High City soon. See you
Sounds
soon.
good. Thanks.